What is going on? Happy Monday and welcome on into today's Power Hour live stream. Market was up. Apple hit an all-time high. They've got their a little event going on right now. They just unveiled their new VR headset that they're coming out with. And the market, initially it's kind of one of those like buy the rumor, sell the news. Although Apple is still green on the day. I believe it may have went red briefly. It did hit a new all-time high though. So if I broaden things out to the weekly chart on Apple, we did eclipse a new all-time high by about like $1 or so. The prior all-time high was like, well, maybe even $2 almost. Prior all-time high was up around 183, and we popped up to nearly 185 today on Apple, which is an insane move really from those December, early January lows, if you think back to it, because what a chart like this was setting up as we've talked about, I think we talked about this one last night on our live stream, was, we were just in this downtrend and we really haven't, had a lot of pullbacks. There was a small one right here, but I mean, look how many green weeks there have just been compared to red weeks ever since the beginning of the year. You could count on one hand, and actually literally there's been 5 red weeks on Apple. Or at least this is. Let me change my my candlesticks. Let me go to hollows. Maybe it's been 6. Okay, there's been 6 red weeks. 6 red weeks on Apple since the start of the year, which is pretty crazy. And there's been a lot of weeks in there, a lot of green. And those red weeks were not that big compared to some of those green candles. But that said, here we are, right? We got some big news coming out. Apple's still going on with their little meeting, and they got some talks with Disney. They're partnering up with Disney to create some content for their headset. They are partnering up with Unity, ticker symbol U, which I believe probably just spiked off of that news. Yep, there you go. You may have even halted that thing up. Yeah, you think you halted up on Unity software. So they're partnering up with Apple. So if you had played, some of those sympathy plays to Apple or to kind of like the VR space, well, you might be doing pretty good today. Definitely one of those days. But I hope everyone's doing well here on this fine Monday afternoon. I went over, I had like 3 trades today. 3 trades. It was slow because it was pre-Apple event. And so I think the market was, or at least tech and stuff, was kind of waiting for that. And the market pulled back since. So I'm kind of glad. My thought process was, I don't really know if I want to be holding through this event. Speculation was buy the rumor, sell the news, although I'm open to anything. Like, who cares what happens? Whatever happens, happens. So I was like, we could rip, but if we're up a lot going into it, do I really think we're going to go more? I have my doubts. So I was like, to be honest, at that point in time, I'd much rather, because the charts look good. Charts are bullish, this morning and stuff. So there is no shorts to be had, in my opinion, unless you're playing the contrarian side or shorting resistance, which I don't really do. I play more so with the trend, with the break, in the direction we've been going. So yeah, that's kind of where my head's at. Funny enough, oil gave back pretty much the entirety of the move off the news yesterday or this weekend. Oil's back. It's pretty much flat on the day. It's up 0.25%. I mean, all we can see is what's happened on oil. Maybe it's gonna go higher, but it just seems like all of these events. The last one was back in here about the beginning of April. Now we got another one, small. All of these news-driven events on oil just set up pops to reshort. And I'm not shorting it necessarily, but it just seems like it's trapping in more longs every time because the trend is continuing to go down and it's heavy, heavy, heavy. That's what the chart looks like. Realistically though, is this a spot that I'm like, oh, short the hell out of oil right now? No, I don't really care. I have no interest. It's it's come down a lot from where it was. And, the next key spot is going to be around 61 to 62 bucks. You go below that, the chart doesn't look good if oil was to break below here. But then again, that's a big move down. You'd probably be talking about more of buying the dip if we got into that area. More of the buy the dippers would make sense, potentially a bigger picture. So I think oil is kind of like a stay away for me as of right now, even though things don't look great. I will say that. Crazy day. Crypto had some trouble today. Yeah, there was some news there. New 12 futures today. A little aggressive breakout on the 43. Let's see. What do we get on? Yeah, it did. I mean, you got that spot And then here was the spot that I was watching. I didn't trade futures today. I just traded options. But, you had a couple small opportunities to break Friday's high. Did it here, but that was a short-lived move. And then you had that move going into the Apple event. It just seemed like, buy the rumor, sell the news to me, it was a little fishy going into it, knowing it's, Apple's one of the largest weights in the S&P. So that said, potentially a downside potential setup breakdown here, setting up if we drop below these lows, which looks like that could be an idea. Could be a valid trade on the downside. Wow, from Greece. That must be awesome. Hope everything is going well there, man. That's great. Wonder if I should roll up my short put 170 IWM, collect a little more premium. I was interested to see how that was going to play out when it comes to like this week. And I was kind of thinking, based off the strength on Friday, that IWM would be stronger. It's not. A lot weaker than I thought it would be this week, but that's why I don't swing trade like that over the weekend, because, who knows? You find that you have these thoughts, and you'll find that you'll be right sometimes. Maybe it's 50-50. Maybe it's 20-80. Maybe it's 70-30 in terms of your like right versus wrong. You'll find that, but even if you are right less or you're wrong more than you're right on stuff like that, like I call it like hunch trades or hunch ideas, you'll have many more. You forget about all the ones that were wrong that wouldn't have worked. You're like, here's my hunch, right? I'm thinking, let's just say my hunch was, I think IWM might be stronger this week if the market's green. Now, the market's it's actually red today, but market's actually red. But this morning it was green. In IWM was red. It was actually pretty deep red early on, before the Apple event and all that stuff, before the market even kind of rolled over. And so it's easy to see those scenarios and go, it didn't work, and forget about it. The ones you'll remember will be the ones that you have that FOMO, like, oh man, I knew that was going to happen. I called that last week, or I called that yesterday, or I called that earlier, and I didn't take it. That's the one that stays at the front of your head. So it's really kind of deceiving, because it makes you think that your hunch trades come out to be more green than red, or they're more often right than wrong. But you forget about a lot of the ones that are wrong. You brush those aside. Oh, yeah, it didn't work, whatever. And then you completely forgot I even were thinking that 2 days later. That's at least how I feel, or that's, kind of how my brain works. And so it's something that I've completely eliminated the past couple months. That's for sure. It's just not, what's the point? What is the point? IWM contours a boredom trade. Well, sometimes, there's a way, or there's potentially an art to feeding the FOMO, to feeding the boredom, but doing it responsibly. You know what I mean? And that's where I kind of find that I think the selling options is awesome, because like you can go and rip through, any of the positions in my portfolio and say, hey, did I sell? Do I have any open covered calls here or is there any puts I want to sell? And and let's just go sell something. Let's just go get a couple bucks of premium, and if it ever fills, if it ever hits, then I'm happy to take my profits there if it's a covered call, or I'm happy to buy that stock or that ETF at that price if it's a cash secured put. I was thinking about that. I mean, we're not in the ballpark, I think, for puts right now to sell puts. I just, where are you going to go and sell puts? Like, what stocks do you want to sell puts on? I don't know. Maybe you could do it on some of the beat down techs, but like we were joking about AMC a few days ago, and like, yeah, I guess you could do that, and you could sell puts on AMC, but like, do you want to buy AMC? I don't want to buy AMC. I'm not an AMC guy. I never have been, never really got into, I mean, I did actually buy AMC, I think somewhere in like the 1s or 2s before the big run, sold it at like $3 or $4, and that was it. Missed out on the massive move. That was my experience with it. But like right here, like I don't think I really have any interest in AMC as a company, like long term. But at the same time, like, do you want to short it here? I wouldn't want to short this thing here. You're asking for trouble if you want to short it here. I mean, look at the runs it's had. It's had some big runs and big squeezes. Have those sustained? No. So would you want to buy into a spike or buy into a little short squeeze or into a rally? No, definitely not. But based off the history, but it's kind of like, like you look at stocks like that, like, you're trying to go find deals, and like, you'll have to look for crap like this to find deals. Cause a lot of other stuff's gone up and up. So you want to find stuff that if you're selling puts, that's been pressure, and those put premiums are nice and juicy. And so it's not as easy to find when the market's been strong. Although you can go and look at other sectors like small caps and some of the growth names, and you'll get better deals on the put side, or you can get juicier or more inflated premiums. You could find some, but not as much as I think on the covered call side. You can find some really nice covered calls. For example, I was even texting my dad this morning. I was like, hey, Apple hit an all-time high. You sell any covered calls? He goes, yeah, I sold some 185s for this week. I'm like, let's freaking go. Because now, hey, do we know that Apple was going to dump like this? No. Like, do we know Apple was going to dump, from where it was, hit an all-time high, hit just shy of 185, then drop $7 the rest of the day? No, but it's set up for the buy the rumor, sell the news going to their event, so it's kind of funny. And it's. But hey, if you took advantage, like for example he did, and he sold some puts, I think he sold them probably like a little bit off the open. Who cares? He sold some puts. He sold some covered calls, not sold puts. He sold some calls because he has a large Apple position in his portfolios. Great, you sold some. He was thinking. He said this week he sold some 185s. And then he was looking at potentially going out for the 200 strike price into a couple weeks out or something like that. And along those lines. So for example, if we can pull up the Webull charts right here, we were looking at this one last night. And if I go out and we're looking at the September 15th, 200 strike price covered or calls. And if you jump over to these things, see if I can pull up the option. Why is it not on the weekly chart? There you go. So this morning at the peak, now of course no one's going to get the peak, but you could have potentially, sold this Apple September 15th. Now, September 15th is kind of a random time frame. I don't know. We just kind of threw it out as an arbitrary number just to go out a couple months and to get some better premium. But you could have sold this thing and got paid, let's say you got it around $3, $300. You could have sold a covered call on Apple, $200 strike price, covered call on Apple for $3. That's $300 in your pocket, and boom, you can go on, a nice little night out, or you can take that money and now you got $300 in your pocket. And if Apple gets a $200 by September 15th, you're like, hey, I'm happy to take my, additional 10% from where it's at right now. I'll take that on top of the whatever the hell percent it is up from, the beginning of this year, So that's kind of the view that I was thinking about it. If you're overweight in a stock of that. Now, of course, you got people on the other side who are like, well, never do that because you sell covered calls on the positions that you want to hold long term. You're asking for trouble and you'll probably miss out on some of the big runs. That's very true. It's possible that you'll do that. But I'm more so talking about if you're overweight or if you have a strategy that's not necessarily, for me, it would be like, I don't know if I'm going to be a big time singular individual stock investor over the course of my lifetime. That could change, next year for all I freaking know. Maybe I get into it again, where I get into it. But I don't really care to have individual stock risk. I'd much rather have overall market exposure and have that diversified exposure with the dividends and then being able to sell covered calls on that to cash flow it. You miss out on potentially some of the gains that you could see off of some of these individual stocks like the Nvidias, like, Tesla over the years, like Apple you're kind of seeing right now. You could, if you had a 50% portfolio weight in Apple and Apple goes up 100% over the next 3 years, you're going to freaking kill it, But the S&P goes up 10% every year for the next 3, for example. Well, you're kind of missing out if you didn't have that, sure. But the exact same thing is true on the backside. And so it's just more of how you want to think about it. And then you're also going to have those losers. So I'd much rather not have to worry or have the mental capacity to think about the winners versus the losers and all that stuff, and just go into the overall market or go into a fund or go into an ETF that's diversified, personally with a nice fat dividend. That's where my head's at now. Apple prices Vision Pro headset at $3,499. The fuck? That's freaking nuts, dude. Is that actually what it is? Let me see if I can pull it up. Oh, right there it is. Apple Vision Pros or the Meta Quest 3s? Which one are you buying? The Apple Vision Pros going for about $3,500 and the Meta Quest 3s for about $500. That's interesting. And that's set to come out in early 2024. Imagine we're into like, now, of course, right? Apple's playing the long, who cares, right? But I'm sure these prices could kind of come down, or they'll become a little more reasonable as time goes on. You'd hope. But imagine if we have this scenario where like we go into like a recession into next year, and like we are like Apple drops this $3,500 fucking VR headset. Who the fuck's gonna buy that? No, like I mean, maybe over the long run, right? You know, who cares? They don't really care about the numbers initially, but who the fuck's gonna buy that? That's my initial reaction. Absolutely not. I don't care how much, you know, how big of an Apple fan you are. I mean, unless you can expense it for like a business purpose and you can write it off against taxes, like, dude, no one's buying that thing. That's funny. Weather and water are warm, the beer is cold in Greece. That's what you like to see. PLTR strong on a red day. Well, I wonder how much of a factor with some of this VR stuff, right? I don't know if that factors in at all on Palantir. But that chart looks good, man. I mean, hey, we were talking about a spot around 1530, and it got above that level, which is a new high, I think, for the year, I believe, on Palantir. Yeah, new high of the year. Kind of just a bull flag to the upside, breaking out of it. Now, what you want to see is you ideally want to see it holding up here. If this thing just kind of unravels, right, that would not be great. And it probably could provide a nice short, because if you're looking at this, and let's just say the market was to pull back. Now, there's no signs necessarily that this is going to be a sustained pullback yet. We don't know. Let's say the market pulls back, you know, and a lot of that stuff breathes. You know, you look around for some of these stocks that went crazy the past couple of weeks, and there's probably some nice backside. You know, AMD's, Nvidia's, Palantir, for example, maybe Apple, for example. There's some probably good backside on some of these. If these can't break, so this could be kind of like that false breakout potentially on the short side. So if you wanted to hedge, or you were looking at saying, hey, here's my 3 reasons, or here's my criteria why I think this is a false breakout, or this happens, so I'm going to take this trade because of this strategy that I have, then your risk is going to be something along the lines of this high, and then you're looking for probably targets down sub, you know, 13.50, maybe down towards $13 would be cool. But it is strong, so I'm not saying that's the play right here. Right now is actually this like a dip buy, broke out, pulled back a bit, back towards 15, back tested 15, holds that. If it holds 15, this looks good. Looks pretty good. I think $17 is the next spot we're watching. Yeah, why is that? Yeah, it was a prior dip buy zone, 17, next psychological level on the chart. There really isn't a ton of volume on Palantir until you get up into like the 18 plus range, and even that's not much until you get into the 20s. Hasn't traded here for a while. So if you were a Palantir investor, it's funny how things work. It's kind of like the same thing, like the that whole market psychology chart that we let you look up. Let's see if I can find it. Market, I can never spell psychology chart. Like, I don't know what it is about psychology. I just cannot do it. I always have to autocorrect it. Like, it just doesn't work. My brain has never figured it out, and I've never memorized it. I can't do it, and my brain refuses to do it. So I just kind of start typing in like PSY or PCSYs and like shit like that. And then eventually I look for where the autofill is, and boom, hit the button. Like hit the psychology, because like just my brain doesn't work. But it's kind of like the same idea, right? If you look at Palantir's chart, right, massive move, kind of had this pop, consolidate kind of a bit, try to push up for a bit, you know, right here, tried to push back in here, and that kind of fills that complacency period. Then the big time move down, and now you're kind of in this like disbelief period right now, disbelief / hope, maybe even, you know, setting the next phase up. I don't know, but you had that big move down, and, you know, a lot of people who Palantir investors are, you know, bulls for a while, who are buying it, who love Palantir all the way up here, stopped out, exited, got out of it down in here, and didn't want to hold over the past year or two. And now they're like, oh, fuck. And they're probably getting back in and, you know, jumping back in on Palantir, riding this train when, hey, you had a chance to buy under $10 for months, for like a year. And now you want to buy it at 15. That's not the way I'd go about it. But for psychology, that's how it works, right? The greed and the fear and greed is whole thing. Hoping to not go over 17 till Friday because I sold some covered calls. Hey, it's not a bad spot though. And I would expect if it does rally through this and get to 17, you'd expect, it doesn't have to, some sort of resistance, something there. Something. ETFs to the gym. You get 80% of the move without 100% on the losses. Who's relying on a $3,000 purchase in a rising interest rate? No, I mean, people are, what they're going to do is, well, maybe by then rates are coming down into early 2024 for all we know. And they're probably going to be at least poised to start coming down by then. You know, I would think. Oh yeah, who knows? But yeah, people just putting their Apple Vision Pro headset on their Apple Card with a 27% interest rate. Like, that's what people are going to do. That's what people are going to do. In this environment, especially rising rates, tech is just absurdly expensive. Yeah. No, I mean, I would agree. I would agree. But then, you know, from like a fundamental kind of thought process, I would totally agree with that. But as we know, the market doesn't always have to make sense, right? It can do whatever it wants to do. Let's check back in on SPY. How's it doing here? So it tried to go for that break to the lows, and then it seemed like it held that exact low of the day. SQ looks like that too. What's SQ looking like? SQ block broke out that nice down. That's not a bad chart, man. It's not a bad chart. In terms of like this being your risk level, like right here. But in terms of like the big picture chart, yeah. SQ looks like very similar to ARK, like, you know, and whatnot. So I like, and they're a decent position in ARK, I believe. So I like the ARK idea. It makes sense to me, just from looking at the chart. But I like this SQ, man. It is from like as crazy as it sounds, if you were looking for an individual stock exposure or like an individual stock for a swing trade, like this doesn't look bad. Like if you took a position right here, for example, my stop loss would be like 57.50, which would essentially be this higher low that it established like right here. That's the stop loss, because that would be like the break of this trend. You pulled up, you broke through it, you pulled back, built a higher low, retested and went. You know, I don't want to see us come back below there. Then that invalidates the higher low thesis. So a 2-to-1 risk reward would be something like this, which isn't like insane. It's not insane. If you look back at the big picture, it's not insane. So for like just an individual stock swing trade without having to play options, you know, SQ, you're looking at a 18, almost 20% upside versus like a 9, less than 10% downside on shares, just shares alone. So a lot of stocks in that growth space that could provide some good swing trades that don't really need you to worry. And of course, don't hold through this. Don't hold through this, because that opens you to the possibility of those outlier 20% type of days that you can get caught on the wrong side and be screwed. So I would never hold through that on if I was going to trade it, but until you know, early August, that this might be a valid idea. Markets do whatever they want. I'm fully convinced it's all completely random. Some patterns and trends. Yeah, I mean, I really think I don't necessarily think it's completely random, but I think that there are a lot of games and manipulation being played to the point where, to the average person who does not have insight into those things, you have to assume it's random, because if you don't, like, you're setting yourself up for failure. And I saw a video, I forget where it was. It was a trader who was talking about, maybe it was a quote, it might have been a quote, or it was maybe a video and a quote popped through this weekend. And it was talking about how someone who tries, or traders don't try to predict where the market's going to go. They have a plan for, you know, essentially X, Y, and Z scenarios. They're going to do these things if they see these things occur, versus someone who is kind of like that amateur or that consistent loser is trying to predict where the market's going to go. And it's so funny, because I'm like, I feel like that's so true about like trading in general. And we talked about this last night. And we were talking about this last night, and we were saying, like, you know, I think Beach Bum was saying, you know, how do you get people back and excited about the markets and trading in the stocks again, or just, you know, whatever. It doesn't have to be stocks, it could be anything. And I think that a big way is you're gonna have to ride the wave. Like if you're someone in that space, you have to kind of ride the waves of like the ups and downs of the cycles of like when the markets are doing well, people get interested. When things are hot, when you're getting short squeezes, when you're getting big moves, when things are quote unquote easy, outlier moves. Yeah, like, you know, and you can kind of ride some of these kind of trends deeper where you can catch on and jump on, like, for example, like the NVIDIA train. You could have caught onto this train even a month ago and still rode out a nice gain, you know, even a month back, right? You could have been in from like 275 and still been up, you know, over $100 a share. Crazy as that sounds, right? So when you get events and times like that, the biggest thing is like, I think is to direct people towards two options, investing or trading. And you can be both, but they're two different things. You can't do both at the same time in the same account is what I'm kind of getting at. I guess you in theory could, but your mind's not going to be focused. So if you want to be in this game longer, you have to kind of get away from the fact that, yeah, maybe things were easy. Maybe you got into things because you heard it from a friend or whatever, and like you kind of started getting interested, and that's great. But now it comes down to you figuring out a strategy, you figuring out an approach that's going to keep you in the game through, you know, periods like this and periods like this, right? And then periods like this, consolidations. So that's the biggest thing. And I think that's where or at least my focus has been the past like year, really. It's been more so like, okay, I recognize this stuff and I'm like, okay, we got to, if you want to be in this game, you know, you can kind of, for the long run, or you want to be trading for the long run, you have to kind of pull yourself away from trying to time the market and thinking you can know what's going to happen and getting all caught up in the narratives, this narrative, that narrative of, oh, rates of this, and here's why we're going to do this, and here's why we're going to go to new lows. Who fucking cares? Market's going to do what the market's going to do. So that's where my mind's at. I think that's where I think a lot of people, if they want to be serious, have to shift into that way. Oh, ARK is how I play ARK unless you do the calls yourself. Yeah, that's probably the safe way to do it. To get paid monthly, right? The monthly covered calls on, or dude, also with this too is like, if you think about it, like if I think about this from that perspective, because I'm like, I might buy ARK, and yeah, I would sell the covered calls myself, but like, you know, the summer comes, you get busy, you forget, or, you know, whatever. So you can go get a nice dividend on this and at the same time capitalize off of potential appreciation. So for example, from low to high on OARK, you would have had about 14% plus the dividends over that period, which you only got about 1 in May if you bought the absolute lows on, this is the option income on ARK. And if you were to go with ARK, for example, since that same time, right? ARK did about 20%. So like it ends up being a very similar number. But the reason why like I like that idea more is because that allows me to go maybe with 2 different growth ETFs instead of 1. So ARK's $42. I would probably need to sell my Soxal, the majority of that, to then feel comfortable with going at 100 shares to be able to sell covered calls. But I could go with OARK and spend, or I could buy 200 shares of this and still pay less than what it would cost me to buy 100 shares of ARK, and to be a little bit less, to go on to less margin potentially with the hedges that I've got. So that's kind of the thought process of that. I like this as a better option as of right now than playing straight up ARK. If it goes crazy, maybe there's you can potentially miss out on some of the gains if it goes insane, but I mean, I'm not really here for that necessarily, right? So, and then that would free up some, I probably, let's be honest, I probably would take this and then I would find something else and start building a new position, or build a position in something else that maybe is around a similar price if I find something. If I don't find something, I'll buy 200 shares of it and just kind of call it a day. But that's only if SOXL, which is my 3X semi exposure, which is kind of like my way of playing the growth trade right now. By the 16th, this needs to be over $21 for me to get taken out. It may not. It fell back under 2021 today. So it may even pull back, and I could see it come back into here for sure. So if it kind of does something like this, great. I sold a pretty juicy covered call. That's going to be nice cash. That's going to just be, that I'm going to keep, and then I'll sell another one. My plan on this is there's a good chance that I'll probably have some sort of trailing stop loss. It's not really on the forefront of my mind right now because we're so high up. But if we come back down like below here, I'll probably just get rid of it all. Because my average is in the 10s. So I don't want to take a loss on this situation. I wouldn't want to take a loss on it, but we'll see how we're feeling if it did come back down there. We got plenty of time to figure the thoughts out on that. Because that's the only true growth / tech exposure that I have in that portfolio. Other than that, it's more diversified into other ETFs that are not really focused in tech. So that's why I want to be, careful, but I also want to make sure that I have some exposure here. So we'll see. In the meantime, if it does go higher, I've got limit sells set at 25, at 30, and 35. As crazy as those may sound, I don't think it's that insane if the market wants to go higher. And I got 140 shares left of it. And so 10 shares every $5 higher, starting at 25 is what I'll sell 10 shares. And then I'll have that last 100 shares eventually get taken out by selling covered calls that'll eventually take me out on them at some point down the road, or maybe this month, not this week. Next, I guess technically next week is the end of, the end of next week would be the 16th, right? It's next Friday. It's the 16th. People are excited about NVIDIA and Apple. They'll be hurt once it goes back to earth. I highly encourage to look elsewhere if you're just getting into the game and you're like, hey, what do I want to buy? And you're going to have that emotional feel. Fundamentals and valuation is how you make money in stock picking. Otherwise, you're set up for 2022 again. No, I mean, if you're not going to take the time to do any of that, or you're not going to care, to me, you can do, and there are people who have made careers off of that, right? Think about the Buffetts, and think about what's that guy's name? Peter, is it? I forget the guy's name. There's a bunch of big names. There was another one that came to mind off the top of my head, but there's a bunch of them that have made a living or made a career off of just kind of and picking some of these stocks and doing the fundamentals and doing the research and diving deep into the companies, touring the facilities, doing real due diligence, not some bullshit due diligence where you go online for 5 minutes and look up a couple pictures. Dude, there's so many penny stocks. You can look up all that crap and it's just all bullshit. If you traded penny stocks, how many letters in the mail for settlements and lawsuits and this and that are you getting because of the companies that you traded or owned, for a couple weeks or a couple months, years ago? I got another one in the mail yesterday. I get them all the time, and they make themselves look good at the time, but they're just scams and pieces of shit at the end of the day. But if you're not going to take the time to fundamentally do the research and do the work, then, dude, just go with an ETF. Go with a diversified ETF and then get a dividend and then sell covered calls. That's where you can have your fun. That's where you can spend, or that's where your head might find more enjoyment or more interest there. And then you'll start thinking, okay, well, if I did this and I sold a covered call this far out the money every month, and what would that be in terms of an additional dividend / additional return on my money over the course of 5 years and what about 10 years? That's what your mind might do. Great. Someone else might say, hey, if I could figure out the next Tesla, for example, right? And maybe they're looking at a stock, I don't know, if there's Palantir as an example, maybe that's a Palantir idea, right? If I can figure this out and I go hard into Palantir and I know it so well and I've done all the research for months and I got Palantir at, $8 a share and I load the boat and Palantir goes to $100 a share in the next 5 years or 10 years, that's my ticket, right? That's where, that's someone else's strategy as well. You could have that idea or that strategy too. The only problem is that I would say that takes a lot more time and a lot more energy and a lot of work, and also nothing wrong with it because you could do very, very well, right? It'll be worth it in the end if it does do something like that. But there's going to be a lot of companies that you'll find don't work out that same way, right? That don't work out. And so are you going to be able to, can you have that problem when you just go with like a diversified ETF? I mean, not really. Like you're kind of at the mercy of the market. You're not at the mercy of one company or two companies or three companies, that you picked. You're at the mercy of the market. So, and the companies don't get into the ETF by accident, right? There's extensive due diligence that's done to allow them to get into the ETF, right? So while potential returns are maybe not as high as what they could be if you do it all yourself, the ease of the barrier to entry, I think, is a lot lower. And the ability to get into the game is much easier, and the longevity is there for sure. The only problem, again, is that like you just have this like perpetual fear of never or thought or like feeling of not being enough, of not having enough money invested, not having enough this, and feeling like shit because your portfolio is not big enough and you're not cash flowing enough and it's not able to do this and that. But that's how everyone starts, right? If you think that way, you'll never deposit the money into the account anyway. You'll never, compound it. Like I go back and think about it. If I was just thinking the same way I am now, back when I was 18, it's like almost 7 years ago now. Like, yeah, I would have been, where would I be now? Well, I don't know. Maybe I would be in a much different place for all we know, right? But that's the power of compounding. Managed to close my stock sell option for 0 extrinsic and sold the shares. Looking at a weird spot. What to do next? My main core portfolio, but I also don't want to get too complacent. I feel like if that's the feeling, and this is just kind of my experience, if you're feeling like that about like not sure what to do next, I think seriously, just chill. Like there's absolutely no rush, because there will eventually be a period, or there will be an opportunity that will hit you, and you'll say to yourself, this is what I've waited for. I've seen this, or maybe that's market gets sold off substantially, and we go into deep fear mode, and we go into crazy put volume and all this stuff for all we know in, let's say, whatever time frame, and then you're like, dude, this is the time that I want to be buying, whether I'm going to be right next month for a bounce or I'm going to be right in 6 years because this dip buy is going to pay off. I know that if I'm playing the long game, this is what I've been waiting for. And if that's what it comes down to, that's what it comes down to. Just the feeling of like feeling you have to do something is not pretty. I think it's very, very toxic, because I've been there. I still feel like that sometimes. But you really don't. You really don't. Wonder how Gorilla's holding up. Yeah, let's take a peek. How that chart's looking. How are they doing here? Grill's looking not bad. I mean, it's not looking too bad. That thing did pretty good to start this year, and surprisingly enough, it actually held up pretty well. So talk about that deal and a half that you could have potentially got on Grill back under 40 cents. And some of us were in that. I was in it from somewhere in the 30s, I believe, or 40-ish. I don't know. I forget where I was. And I sold the last shares up in the upper 80s or $1 or something like that. But that was a crazy 100+%er. That was crazy on Grill. It's doing its thing, man. It's holding up, which is kind of cool. Option funds dividend ETF strategy that wins 4 to 5 directions. I don't know about you, but I'm a probabilities and numbers guy. I think too, when margin comes back down, yeah, that's going to be nice too, because then you can start to kind of justify potentially having more money invested. But I think too, it makes it on the mind when it comes down to it, like the amount of work, it's like we talked about, it's like the Beach portfolio, like Beach Bum, right, is a great brand. It's a great branding, because like it's like what you could get to, and you can get to that at any time, but that's like the goal for me, is to kind of be at that point one day where it's like everything can be done from the phone, on the beach, wherever, as long as you got a connection. And all I'm doing is selling covered calls, maybe selling some puts if the market's dumping, and then just funneling money into dividend plays and into positions. And then, when the market's as the market goes through its ups and downs, right, that's when you can take advantage of selling covered calls. And the market's going down for a while. We're getting pretty fearful. Sell some puts on stocks maybe you want to buy when you've got extra cash, and maybe some hedges here and there. But all that stuff, you don't really need to worry about charts too much. It's pretty straightforward. It's pretty simple. Again, it's not necessarily easy, but it's simple once you understand the backbone to it. And you're not day trading, I guess you could, but I wouldn't be interested in doing that on the beach, to tell you that. But that's like the game. That's like the goal, when you build a portfolio to that size, that you could do that type of stuff, because then the dividends are paying for that. Smalls were fun in quarter. No, again, and hey, we're in a quarter 2 now, right? Not a huge deal. Get to September, October. Let's see how the market kind of reacts. If we go through and, another one of those kind of like periods where September, October kind of is weak on the market, then what we want to start doing now, of course, this is like way out there. We'll start looking and starting to collect maybe a list of small caps, kind of like Grill that we did back in the day. Because look at that. Like, look, if you thought about it, right? What the time was here. So that was September, October. That was like right in here. And if you picked it up in November, November was that dip, and you would have had a nice monster move. So then you want to start looking into that November timeframe before the holidays, the Thanksgiving and stuff, is when we start looking at small caps again. That's just kind of like the seasonality, like these cheap stocks, and looking for the quality, like making sure we look for quality names. Of course, anything could go, but looking for the quality names that are a little bit safer than like the piece of shit stocks. And then on top of that, maybe there's growth or there's other sectors this year that get just wiped the rest of the year. For all we know, maybe it's oil, maybe it's other sectors, who knows, that are weak, or maybe it's, retail. And then that tax loss harvesting period at the, November, December timeframe, you start seeing pressure. Those are where you can start picking up maybe some deals or shopping for deals. The market could, of course, go higher and higher and higher. If the market's ripping from like September through December, maybe there's going to be less of that. But if the market's weak or kind of choppy or whatever, there will be individual sectors and stocks that'll probably provide good deals. So that's kind of like the time horizon that I'm thinking about for like buying the dip on stuff. If the market's going to just kind of do its own thing for the next, who knows how long. Of course, there'll be a lot of games to be played in the meantime, but on that next cycle, I think is when there'll be some good opportunities potentially. At a minimum in small cap land, maybe also across the broader market, but we'll see how the market kind of goes for the next 6 months, and then we can start talking about that, right? But yeah. Confident I'll know deep down when I see a good opportunity. Yeah, and that's I think what it has to kind of come down to. Like, even like if let's say you're just kind of dollar cost averaging into like SPY or whatever. I'll pull up SPY in the meantime. Like, if you're dollar cost averaging into like a SPY, like, don't stray from that if you still have the ability to do so, like in now. But if you're stacking excess cash, like, because you're like, I don't know what to do with this money, I don't really want to buy anything right now, I just feel like it's expensive and whatnot, then that's fine. Just stack it, get paid interest, like put it in a high interest savings account, or if your broker is paying you to hold that excess cash, like a Robinhood, for example, maybe, and it will hold that uninvested cash and pay you a 4 or 5%, whatever it is these days. That's great. And then when the opportunity presents, you'll be there ready for it in the meantime. Jeppy JVQ SPYI. Yeah, no, I that's, instead of having to sell covered calls, let them do it all for you. Yeah. That is almost like an addicting portfolio style, right? When you can just kind of sit back and get these monthly dividends and like collect them, or even if you're someone who likes the individual stock perspective, but if you've been able to kind of accumulate a portfolio that's nice enough, large enough to where you've got dividends from something coming in every month because of the quarterly kind of dynamic of a lot of companies, you've got monthly dividends through that, or if you go with the monthly ETFs. I think I should take advantage of Robinhood Gold, get 5%. I mean, what's it? Robinhood Gold's $5 a month. you know? So if you can do the math on that and like think about like, you don't even need to get gold. I guess you can go with I don't know how much or how bad we can look it up. Robinhood interest rate. 4.65 on your idle cash. Oh, that's ass. Without gold, it's 1.5. That's horse shit, man. But so like do the math. Like for $5 a month though, right? For $5 a month, you know, will you make 4.6? Like, is that worth it to you or whatever, right? As long as it's worth it to you, you're fine. Also, the margin investing is pretty nasty here too. 12% rates for freaking margin if you don't have gold. That sucks. Like, that's not an ideal number, above 10% if you're on margin. Although at the same time, the same token, if you're just using it for short-term stuff, yeah, whatever. But yeah, I mean, 4.65 for gold, and that's kind of like their barrier to entry, make you pay $5 a month. And essentially that's such a small number, most people are like, yeah, I'll do that. And I mean, hey, if you've got decent amount of cash, that $5 a month is paid for pretty easily, going from a 1.5% interest rate to a 4.65. And if you use margin, saving money on the margin side as well, a few percent there. So that's where it's at, if this is something to think about. But hey, if you don't want to use Robinhood, like there's other, you know, if you just have cash and you don't want to pay for like gold or whatever, like go to a high interest savings account. Like there's great ones out there. There's like Wealthfront. I'm pretty sure if you look at like Wealthfront, let's see. Wealthfront's paying a 4.55 APY on short-term cash, you know, here as well, right? So it's the same kind of idea. No account fees, no minimum or maximum balance to earn that 4.55, unlimited withdrawals and transfers, 5 million FDIC insurance through partner banks. So you can start with $1. So, I mean, like if you don't want to pay for gold, like go to something like this and put your money in here until you want to put it into your brokerage. You know what I mean? So that's kind of a way I would do it. If I wasn't already fine with my Robinhood account, where I was looking for an additional account. Gold is absolutely worth it if you use margin. I would agree. All right, so sector-wise, XLV Healthcare is up today. XRT Retail is down. Where's Target's down there 2%. Is that new low? No, it did hit a new low on Thursday. Not to new lows of the year. If I put $5K into Robinhood, made 4.65, made $232, minus $60 for gold for a year, so you're making 162 or 172 profit. Yeah, I mean it's better than nothing. And then the money's right there in the account. And then you also get the perks of gold and whatnot. And I'm sure like if they have other updates and other things that they release, you know, it's not a bad play. But to be honest, if you wanted to avoid the $5 fees, Wealthfront, I would say is probably or something equivalent to that is a decent way to go. So we talk about retail. XBI, funny enough, look at XBI. Now, let's go to like the daily chart on XBI. Dude, bios are looking pretty good. This is an interesting chart. Of course, we have technically not broken out of this downtrend here, but one may hypothesize, if you want to use that term, that on the break of this, maybe we get a push to a new high of, no, not new high of the year. New high of the year wouldn't be that hard to do. Up towards $100, somewhere up in here. Looks a little more reasonable to me. And where is your risk? It's this higher low that we just built the past like week or two, right here. Nice higher low just built, right at like 82.50. Dude, it looks like a pretty decent idea on XBI. Now, like if you're saying like, of course, it hasn't broken out. just yet, but maybe there's a Labu trade in someone's future because of this chart. Just looking at that, like if you were to go long right now, stop loss under the recent higher low, 82.50 area, 2-to-1 risk reward just for kind of a rough gauge. You're looking up around 96.32, which would be a new high of the year. We'll be back to like the August highs of last year. So it's a decent move, but hey, chart's setting up like it's not unrealistic. Not unrealistic for something like that. You maybe get more than 2-to-1. You may be able to get up to 3-to-1 if the thing really wants to go. So keep an eye because it's been strong, right? XBI has been strong. It kind of pulled back the past 2 weeks and it's built a nice little base, making a nice little higher low. And it's something that doesn't need to have SPY going up necessarily to go up. It's done its kind of its own thing. There's plenty of opportunities or days or examples where XBI is green and SPY is red and whatever. Or XBI is red and SPY is green. There's been plenty of those days. So the correlation isn't as close to SPY, which makes me more interested because all I can do is, or all I got to worry about is just focusing on the charts versus trying to think about what the market's going to do and trying to say, well, SPY's overextended, so maybe I don't want to buy it now. And you start crisscrossing ideas and your head goes too crazy. Now you're like jumping around and now you're all messed up and you're not just trading the charts, you're trading your hunch and you're maybe hesitant because of your hunch and you're screwing yourself for no reason. Up 8% on XBI. Nice. That's a nice little because I remember you buying that dip and now just working out. Looks good. Charts so far looks decent. Like Labu, kind of the same thing. Labu risk reward would be risking it about $1 downside for about $2 $3 upside. Maybe even get up to $10. Pretty cool. Pretty cool. QQQ surprisingly is actually still green. Although these are some big upper wicks on the charts here today. You've got some pretty big upper wicks. Oh yeah, let me pull up my trades for today. So the first one was Apple. And I took this trade and I kind of forgot about the event today. Knew it was happening, but I kind of forgot about it. I believe I took it like somewhere here. No, I took it here. So here's my line that I had in the sand at this like 183.85. I ended up getting in on this break, and then my stop loss was right around VWAP. So it was like seconds and inches away from my stop loss. It was around like 10 to 12% downside. So got on the break. Was like, oh shit, false break. I'm like, hey, holds VWAP, I will stay in underneath them out. Held that, got this big push to high of the day. And then when I saw this candle essentially have this massive upper wick, I was like, absolutely not. And so I put a stop loss at break even and it hit break even. So I was a literal zero on the day because I'm like, yo, this thing, right, held the VWAP, right? Great, cool, awesome that it did that. That was my max risk. Technically, I could have held on to this and had my risk there and it would have ended up, later on hitting profits, but I would have had to watch Apple for 2 more hours going into the event. Did I want to do that? No. Looking back, I still probably watched charts for 2 hours, but that was, my decision on other stocks. But this big upper wick, I'm like, yo, I'm not fucking with that. Like, there's just no way. You see that? It's just like this move should be a little bit more sustained, and if it's gonna work properly, and it's not, so break even's fine, whatever. I didn't care. Then I had Google, and I had Google right here. And Google was a stock that I was watching, and I took the break right here. Because this blue line that's on our charts is roughly our prior high of the year. So I'm like, hey, Google's got a nice bull flag kind of almost setting up. If we get above this, what is it, 127? That's a good long. Did I want to play Google on that long, like off of this? No, because that's a big move. Those are some big candles. It's pretty volatile off the open. I'm not a huge fan. You got to give me more of a flag or more of a tighter consolidation and easier to develop pressure on a level. And that's what I then saw right here. So we have about 4 candles all rejecting at around the same spot at like 127.37 roughly. And so I entered on this candle right here, and we got about a 10%, maybe 12% move to this high. I had been playing. So the way that I'm playing it is depending upon the contract price, I have a set number of contracts I will buy. So if the contracts I'm trading are $5 or more, or between $5 and $6, I'll buy this many contracts. If the contracts are between $1 and $2, I'll buy this many. And so if the contracts I chose here, I bought 4 of them, and I bought 4 contracts. I sold 3 once we got 10+% on the move, and I had that extra 1 to ride, and I put that 1 at break even, which then ended up triggering and hitting right here. It ended up working out because, I guess kind of, because we didn't go to a new high of the day. We actually went lower, and so stopped at break even. But that was not a huge win, but it was a win. It was a little win. Could have been bigger if Google went for more, but that was it. And then QQQ, and I logged these all into TradeZilla. So QQQ, I just download my Webull spreadsheet at the end of the day, my Webull whatever CSV file, and upload it to TradeZilla to track all this stuff. QQQ, kind of the same idea on this one, and it was honestly should have been a loss based off of how it worked out, but I played this break right here, got a little pop, and then it came down hard. My original stop loss was this wick, so I'm in this thing saying, hey, I'm going to risk it down to 356.27, which is right here, and it technically didn't hit. And so I was getting close though to hitting that trigger on the stop, and it got down about, I would say like 9-ish% of drawdown on the position, which is pretty close to my max that I want to be holding around 10. And sometimes it could be 12%, whatever. But as long as I keep it around 10, it's like my game plan, ideally under 10. But sometimes contracts are a little more volatile and whatnot. If I'm buying, the same week expirations, like Monday, Tuesday, I'll be playing Friday's contracts. And once I get to Wednesday, I'm going out to next week's expiration next Friday. So when you're in the same week, they're a little more volatile. So the drawdown could be a little more volatile. This big move was kind of like, oh shit, but then it got bought up immediately. So I was like, oh, hey, cool. And then it just got stuffed. And I ended up saying, I'm not waiting anymore. I'm going to the gym. I have other stuff I got to do today. I have other work I got to get done. So I have to get out of this thing. And I took like a 3% gain on it. And that was it. So somewhere up in here, once it rejected off one of these levels, and I was like, yeah, screw this thing. I'm not playing it. And looking back, that also lined up with like right into the beginning or the minutes leading into the Apple event. And I was like, yo, my plan today was to be done and to not be holding and trying to trade through the Apple event, because who the hell knows? Like Apple's got such a big weight in QQQ and SPY and stuff that like it can move the markets. So I'm not going to mess around with this. And that's why I just didn't want to be there for that. And so that was it. So it ended up being green on Google, break even Apple, and then QQQ was a slight green. So it was kind of a day where like things didn't really go to plan. It didn't really work out right, but I was able to kind of sneak out into the green. And it was actually, in terms of a green day, it was a decent size green day compared to like last month. So it was kind of like, one of my nice, not hefty, but a decent green day compared to like last month's average, because I started to size up a little bit. Just a little bit, like that, adding like an extra contract or so, or developing a strategy of, okay, when contracts are in this price range, I buy this many. When they're in this price range, I buy this many, and having kind of more of a detailed plan. This way, it takes the thought process out of it. I don't have to start thinking, how much money is that? How much risk is that taking on? Dollar amount? No. I have it done. It's not. So for the month of June, that's what I'm operating at, and that's it. So I'm going to try to keep it as simple as possible for the month of June, like that, and see how that works. And ideally, if we have a similar month, of course, who knows if it's going to be the same as May, there's no way to know. If it's similar or, around that same kind of month, the P&L should be higher if we operate the same way and if we have the same amount of opportunities this month and we trade potentially similar to how we did in May. So we'll see, but that's the plan of trying to scale up, or trying to start scaling up when we've been doing pretty decent. So we'll see. We'll see. IWM still a chop fest. It tried, man. It tried on IWM. It really tried. Let's see. Yeah, it's like it tried to break the range and it did, and then it's like, nah. But it's still, if it makes a higher low here, it's got this big gap though. Maybe that backfills, and then maybe it wants to go for more. Maybe. We'll see. So with that said, that's how we wrap up today on this fine Monday. SPY down 0.19. QQQ finishes up 0.06, barely. Let's go and look at FinViz. What's like under the surface? So today, the Dow was down about 0.6, NASDAQ down 0.09, S&P was technically down 0.2. Okay. 35% advancers, 61% decliners. That kind of makes sense with everything being red. More new highs than new lows. Also kind of makes sense because we have been rallying, so you would think more stocks would be closer to highs than lows. Maybe. About 50-50 on the 50 SMA in terms of stocks above that moving average, and then similar but just a little bit less that are above their 200 SMA. About 45% of stocks are above their 200 SMA. And then in terms of the Fed, which we got next week, FOMC in about 8 or 9 days, it's now looking like an 80% chance almost that we're going to see a pause from Mr. Powell and the Fed, and a 20% chance that they're going to give us a 25 basis point hike. So that's pretty much baked in. It's funny. I have this app. I'll share it. I want to use it a little bit more, but I found this app that's kind of like allows you to trade kind of more off of some of these like binary events. And I made a trade just to test it out for like $50 on this next rate hike like 2 weeks ago, and it was like options were 50 basis point or 25 basis point hike or no hike. And I picked no hike. And it's kind of like it's like event contracts, like trading event contracts. So you can still get out in and out like a trade, like a stock anytime. But I'm currently up like 80% on this, which is pretty cool. So, and then if you let it expire into the event and it happens, like you pay, like let's say that's the contract's going for 40 cents. You can buy as many as you want, and then it's going for 40 cents. If whatever happens, like if you pick the correct outcome, it returns you $1. So like once the event goes through, if let's say that the Fed doesn't hike, because I selected that like 2 weeks ago, and then if they don't hike, I'm going to get $1 back. So let's say I bought 10 contracts at 50 cents, right? I'm going to get 50 cents times 10. So whatever that is, right? $5. So, and you could do that, of course, make the numbers huge or make them small. So it allows you to kind of play that, or it allows you to hedge. So like there's been so many scenarios where we were looking at it. The app is Kalshi, Kalshi, I believe. Yeah, Kalshi. They sponsored one of the videos on my TC trading channel, I believe, and stock trends maybe. They sponsored one of those, or maybe a couple of those videos, and it's actually pretty cool. So I've been using it, and it's been kind of cool. I might do more with them in the future, but we'll see. But it seems like there's been so many scenarios where like, the Fed like could do this, but then playing the market off of that sometimes is a gamble. It's like, well, if the Fed hikes, that might mean SPY goes crazy, or it was digested already and then SPY does nothing, And so you could just say, hey, well, instead of playing SPY and trying to play off of what I think the potential reaction to this event is going to be, I'm just going to go play the event instead. So it's like if let's say you want to go buy like maybe it's like it's right now 80 cents, for example, because there's an 80% chance it's going to happen. So you pay 80 cents for a contract, and if it happens, the Fed doesn't hike, you'll get $1 back for every contract you bought. Now, of course, if it doesn't happen, if they end up going the other way and they do a 25 basis point hike, you lose it all. So it's, scenario, you got to be careful, but you could use it to hedge for events. Like you can use it as an idea. So kind of cool. It's like binary options. Yeah. Yeah. So yeah. And there's more, there's a lot more. You can bet on like hurricanes and temperatures. Like there's just a lot in this app, which is kind of cool. So it's almost like gambling in your everyday life. Take it with a grain of salt, though, because of course you can go down a rabbit hole and be in a lot of trouble very fast. But with that said, thanks so much for hanging out here on the stream. I appreciate you guys like always. Any links, resources down below. We'll be back here on Wednesday and Friday. And then next week, there's more events and Fed stuff and CPIs. So we'll probably have a couple extra live streams for fun. That's the plan. So thanks so much. I'll see you guys in the next one. Peace out.